Hey guys, it's Jason Lavender. Welcome back to a brand new, fresh episode of Real Estate Investing for Real. Again, my name is Jason Lavender. I'm here with Kyle Turner. We've rebranded, and we're going to actually run an episode. And in fact, you may have already heard that episode. Rebranded. So we are learning a lot as we launch and unveil our podcast. And so yeah, we've got some new things on the horizon, and are excited to continue to unveil and roll out our podcast. So needless to say, though, that's all forthcoming. Today, we've got Kyle Turner. Kyle Turner is a Wichita resident, local investor, entrepreneur, honestly, mogul.
All the above.
Yeah. Empire. So thanks so much for being on the show today. And why don't we just kick off and tell us a little bit about yourself, kind of, as we've talked, tell us the breadth of kind of what you're doing, what all you've got your hand in, and we'll dive in.
Yeah, absolutely. I really appreciate you guys having me on today. As you mentioned, kind of local to Wichita. Been in Wichita about 13 years or so now. Originally from Kentucky, Eastern Kentucky. So that's the accent you hear. What's left of it anyway. It's starting to disappear, but most of it's there. Mm-hmm. Tax partner at a local accounting firm, Regier Carr Monroe. We're probably 65-70% of my clientele there are real estate investors or real estate agents, somebody connected in real estate in some way. Also part owner for Midwest Property Advisors. Main thing we're doing there right now is cost segregation analysis for a lot of clients.
So let's stop there real quick, and that's how I met you, Kyle. Yeah. We'll get into a lot more. There's a lot here, and we touched on those Kentucky roots in just a minute. But cost segregation, tell us, what exactly is that, and what does that mean to an investor?
So cost segregation is the process of basically taking your building, whether it's a commercial building or a residential building, and breaking it down into its parts and sort of blowing out the model, if you will, right? Mm-hmm. Your standard procedure, you go buy an investment property, you put it in your portfolio, and you start to depreciate that property over 27 and a half years if it's residential, or 39 years if it's commercial. And if you go and buy a $100,000 investment, and I'm going to use $100,000 just because it makes the math easy on a lot of stuff. Numbers. Yeah. You're depreciating that over 27 and a half years. And so you're taking a little more than $3,000 in depreciation a year. Mm-hmm. With cost segregation, what it does is it takes that $100,000 and allocates it to all the components of that building, to the roof, the flooring, the appliances, counters, countertops, everything you can think of inside the building, those individual components. And what we're able to do is we take those components and assign a dollar value to them, and then place them in their respective class lives. Mm-hmm. So instead of depreciating the entire thing at the 27 and a half years, we're depreciating a portion at 5 years, some 7 years, 15 years, and then the remainder at that 27 and a half. Mm-hmm. So what we really end up with on, like, again, a $100,000 investment, rather than taking $3,500 of depreciation that first year, you take somewhere in the neighborhood of $25,000 to $30,000. And that makes a big difference for investors.
Huge difference.
It really frees up a lot of capital to continue investing.
Honestly, I call it the cheat code for investing. And again, that's how we met.
Yeah.
You come so highly recommended here. And again, we were in the Wichita, Kansas market. You come highly recommended to investors, and that's how we met. And it's something that I've heard investors talk about for a long time. And really hearing you break it down, and much like you just did now, I call it the cheat code. I mean, it's the legal cheat code.
Yeah, it's perfectly legal.
But quite honestly, for investors that are looking for to decrease their tax liability and really front load some of that depreciation, I mean, that's like a game changer.
Yeah.
Any house flippers are listening. If you've got rentals and you flip houses, you need to be doing cost seg on your rentals, because you're going to defer, correct me if I'm wrong, you're going to defer a lot of your capital gains.
You really defer a lot of gains, a lot of income. And it's a strategy that really works for any real estate investor. There's certain investors that it works better for than others, but it works for everybody in that you've got one chance at getting that big deduction. and that's the year you place that property in
Right.
service.
Right.
And even if it creates a loss for you in that year that you can't really use against other income, you're going to be able to carry it forward for years to come to offset your rental income. You look at, again, our example of a $100,000 house, which is probably renting for $1,000 a month in our market and somewhere in that neighborhood, right? Without any other expenses, you're talking about $12,000 worth of income a year. In that first year with that cost segregation, we produce enough expense deduction, depreciation deduction, to shield basically 3 years of income. And again, that's assuming no other deductions.
Yep.
So if you have other deductions, you're probably talking 4 or 5 years of income on that one house that's shielded.
That's why I call it the legal cheat code.
Yeah.
Yeah, and honestly, that was a game changer for me to understand, and I think it's my first year doing it, and I think you guys prepared 6 for me, and we're going to get into that. That's one of your other businesses, so we'll probably come back to that, but pick up where you left off. You've where you're from. That's one of your businesses. What else you?
So we've got the accounting firm, and we've got MPAs, what we call it, Midwest Property Advisors, and like I said, we do mainly cost segging it right now. We're trying to build that out a little further and really become consultants in the real estate industry for investors and those types of things. So some growth to do with that business and to start roll it out nationwide as well. And then outside of that, we've got a distillery that we launched back in Kentucky, just back at the first of 21, end of 2020. We made the great decision to start a business in the middle of COVID, and so that held us down for a little bit. But it's been great. We just rolled out in Kansas the last couple of weeks, so bottles on shelves here now.
I've seen it.
And then
what are some of your product line? What are you making?
Well, right now we've got a small batch bourbon out that's 90 proof. Actually won double gold medals out in the San Francisco Spirits competition back in the spring. So that's the highest award in the whiskey industry. So we're really proud of it. We've got a couple other lines that we're coming out with. I was shooting to have out this fall, but it's probably going to be a spring release. We're working on a barrel proof or high proof, if you will, whatever lingo you like to use. It's going to clock in at about 116 or 117 proof, so a little higher proof.
I'll put hair on your chest.
Yeah, it's good though. It's really good. We're really happy with it.
I tell you, I've so enjoyed. I've just gotten into an acquired taste for bourbon and this year, and my gosh, I love a good smooth bourbon.
Yeah.
Honestly, and learned how to make me a sweet old fashioned. Those are good.
Well, ours, the brand is 1620, and ours makes probably the best old fashioned I've ever had. I've
got to pick it
granted,
up.
I'm a little biased.
You're a little
for sure.
biased.
Yeah. But it's really, really good.
You don't mind me asking, what's it retail for?
Retail's $39.99.
Oh, that's affordable.
Yeah, that was our goal. We set out
affordable.
to make an affordable whiskey that can be your daily drinker.
Yeah.
Our small batch line is a really approachable whiskey too. We get a lot of wives and girlfriends that are like, I'm not a whiskey drinker, and I'm like, okay, you got to try our stuff then, and they're converted. They like our stuff. You get, in my opinion, you get all of the stuff you love about bourbon, the flavors and the little heat coming down on the finish, without the ethanol burn that you get out of a lot of bourbons.
Yeah, you can always throw a little Coca-Cola if you need to, or whatever.
Yeah.
I think it ruins it. But
I don't recommend it, but
I don't either. But if you gotta,
I tell everybody, drink it the way you it.
That's
You know,
right. Yeah,
that's just how it is, right?
Yeah, so that's super interesting. Yeah, I've got to pick some up, man.
Yeah.
Honestly,
There's a great backstory on it, and if you don't mind me
share it. Yeah.
diverging a little bit onto
do.
that. The name 1620 comes from the year 1620.
Cool, okay.
And the story there is that in 1620, a man named George Thorpe was sent to the Virginia colony to establish a college.
Yeah.
And George Thorpe just happens to be my 8th great grandfather.
All right.
So this is in my lineage, right?
Okay.
And when he got here, he was supposed to establish a college, but he connected with the Indians in the region, and they introduced him to corn. And so he took the corn back and distilled it into what would eventually become corn whiskey, replaced the barley that he was used to using over in England to distill beer with, right? And so our claim to fame there is that our ancestor was the first person in the Americas to distill corn into liquor, essentially. So I tell everybody our family's been distilling whiskey for a little over 400 years.
A little over, yeah.
Some of it legally.
Yeah. That's an awesome story. So, what city? Where in Kentucky?
We're actually in Prestonsburg, Kentucky.
Okay.
It's up in the mountains, up in the Appalachians, in the eastern part of the state. That's where I was born and raised.
That's where you grew up?
Yeah. So we went back there to do it, and got a good connection to the community and stuff there, and those types of things.
That's awesome. Yeah, I can't wait to try that. Honestly, that's again something I've really enjoyed diving into and develop a taste for. Had some good friends introduce me to that, and I'm like, I'm not really a drinker. When I did, I drink some beers and stuff.
Yeah.
But anyway, good bourbon. That's honest. That's awesome.
Well, we definitely got to get you a bottle of it then.
Yeah, you do.
Yeah.
No, that's awesome. I'm glad it's here locally now too. How many stores you rolled out in?
Gosh, I don't even know at this point. It's kind of starting to ease out into all the stores. Wichita, Kansas City, all over the state. It's a process getting stuff on the shelf. We spent about 10 months getting it here in Kansas, and we're
a slow burn.
We're in Kentucky and Kansas currently, and I think we'll have Nebraska and Oklahoma pretty soon, and starting to work on Texas.
Well, if you need a brand ambassador, give me a bottle and I'll be happy to. Maybe you could be a sponsor of our show.
Yeah, absolutely. No, we can talk about that. Yeah,
we did bring some swag here, so I appreciate that. That was kind of you, and showed me up as a host. I need to get some swag. I probably got some Tootsie Rolls somewhere.
Well, I'm all about branding, so I keep trying to push it out there,
awesome.
right?
That's very cool. Man, what a great story. I love hearing that. So we may circle back on that, but tell me what other endeavors and adventures are you currently engaged in? And
from a real estate perspective, again, we've got a small Airbnb that we do out on the farm. We live on about 10 acres or so.
Something unique about that Airbnb. What is it?
Yeah, the unique thing about it is there's no running water. It's just this little cabin back on the backside of my property. It's kind of buried in the trees. It does have electricity, so there's heat and air in it, and it's really I think it's 10 by 12 or so. It's a really small cabin. Got a main floor, and then there's a little loft in it with a bed and stuff in it. But we do really well on Airbnb with it, and we put it on there in December of 2020, I think, as just a joke. Really, just trying to see if anybody would even be interested in it. We were sitting around one night drinking bourbon, and it was just, I can't remember. My son is Sky Turner. He's involved in real estate here locally too, and he was talking about some listing that was on there or something that was like a campsite or something, and I was like, well, shoot, we should throw the cabin on there, and we did that, and then the month of January it was rented about 50% of the days, and
is that right?
Been rolling ever since.
Man, that's awesome. Yeah, there's some very unique B&B opportunities, and I've seen anything from schoolies and rented out, converted buses, campers, she sheds and things like that.
Yeah.
That's awesome. Any plans to scale that or do more or anything like that?
We've talked about it, and we've looked at a few properties of just buying some land and throwing, 4 or 5 of those on them. And they're fairly cheap to do because you don't have to do plumbing and stuff like that.
I looked into this, I still regret not pulling the trigger on it, but buying a tiny home. It was a 16 by 20 shed.
Yeah.
Much like you can get built in, any neck of the woods. There's companies that build those, and basically you insulate it out, finish it out, and it doesn't require anything major.
And that's exactly what we've got.
You plop it on there, then you foundation, put on some skids, and
Yep.
There you go, man.
Ours sits right on our pond. There's a little deck off of it with a fire pit and stuff on it, and it's secluded. It's on our property, but I can't see it, and you can't see the house. And there's a spot to park. I say in the Airbnb listing, it's a 1/4 of a mile hike out to it, but it's really like a 1/10 of a mile. I overestimate it so nobody can complain that way, right?
Yeah, make it good.
And I've got a shop there on the property that they park behind, so I don't see their car, don't see them, and they come and go as they please.
My wife and I've really enjoyed. I mean, we own some Airbnbs as well, but we've really enjoyed traveling and using Airbnbs, and we try to find stuff off the grid like that. And
that's what we do too. We look for something unique everywhere we go.
You got any coyotes out there?
Got a lot of coyotes out there. We've got so many coyotes.
Sarah, did you put that in the listing?
No, I should
serenaded,
though.
nightly serenades from the coyotes.
We've had way more coyotes this year than we've ever had in the
Really?
past. Yeah. It's made the chicken and turkey farming tough this year.
Yeah, so you got
for
chicken
sure.
and turkeys. They're probably
Yeah. We
suffering
raise
with the
we raise
coyotes.
chickens and turkeys and ducks. Got a pig. Got a handful of dogs that we keep out there as well.
Uh-huh.
We breed golden retrievers.
okay.
So we got a lot going on out there. We do bees. Do a lot of honey.
Really?
We sell a lot of honey. Yeah.
You got the whole bee suit and everything.
Yeah.
Oh
yeah.
my gosh.
Yeah. We got 7 or 8 hives out there now.
Not me, dude. There's no way I would do that. I would be terrified.
It's fun, you know. I get stung occasionally. That's
my
a
gosh.
big source of angst with my wife because she hears this and I'll have to deny it, but I am slightly allergic. So
You got an EpiPen around?
I do.
her?
We keep EpiPens around.
maybe she's not.
I keep telling
off
her I'm
track.
not allergic, but yeah, truthfully, I probably am. But you know.
Well, these aren't like African hornets or
Right?
anything like that.
Yeah. It's
Man, so you got a little bit of everything. You said
Yeah. To your point earlier, we dabble in a little bit of everything, and that my wife owns her own business as well, so that keeps us busy. And then we've got 6 kids that range in age from 7 to 27, and they're all busy with their lives, so that keeps us busy too, and
Keep you on your
sports and
toes.
school and stuff like that. Yeah.
so. Something you said I want to circle back to, and I think you alluded to it with your wife. Midwest Property Advisors, a company you've got. I don't know how long you've been in business.
A couple years now.
Okay. So your goal with that is to, correct me if I'm wrong, but to be, I don't know if one-stop shop's necessarily the right moniker, but to be a consultant to investors.
Yeah.
So
yeah,
what,
yeah,
I mean,
absolutely.
as you think about building that business out, what is that starting to look like? And what do you think?
Yeah, you know, we do the cost segs there, and one thing I mentioned earlier, we've been talking about really kind of a bookkeeping service that's geared toward real estate investors, right?
That's needed.
You know, a lot of property management companies out there do that sort of thing for investors, but there's to me there's a segment of investors out there that want to manage their own properties, so they're not interested in having a property management company do that sort of thing for them, but at the same time, they don't want to be bothered with keeping their books, right? Because what they do well is real estate, not accounting. And so, in my mind, the way I operate my businesses, you're smarter to outsource those things that you don't do well, so that you can go do the things you do well, because that's what makes you money.
Is that more like is that software or more like a fractional bookkeeper?
You know, I think it's probably a little bit of both. To be honest, I think there's software that's available, but at the same time, you need somebody that understands the concepts behind it, right?
Yeah.
Just dumping it all into software doesn't necessarily solve all your problems.
Yeah.
Making sure you're tracking by property and by investment and things like that. Because, you know, one of the things that I see a lot with real estate investors, and especially investors that are just getting started, they'll have 4 or 5 properties, and as long as the checking account balance keeps going up, they think they're doing well, right? And
This guy.
we come in.
That's my problem.
You know, we come in at tax time or whatever and clean up the books and start doing the books, and we're looking at it by property. And, you know, yeah, you're making $1,500 a month with your 5 properties, but you got this one property that's costing you $750 a month.
Yep.
So just by either doing something different with that property or finding somebody that property makes more sense for, you'd make more money.
Yeah.
And a lot of investors don't have that visual because they're not able to keep up with their books and stuff. So I stress that to a lot of my clients and a lot of the people that I talk to.
That's key. You know, Kyle, that's interesting. I think you're onto something really there. As an investor myself, you know, knowing some of the blind spots, and I mean, you don't know what you don't know, and having another set of eyes, you know, as a consultant business to really say, you know, here's where things are really looking good. Here's some tweaks, some things you may not be aware of. I can see a particular need for that.
Yeah.
And I don't know how you're going to package that, but I mean, quite honestly, as an investor, and those investors that I talk to, and many of them, you know, maybe listen to this podcast, can attest to, you know, we've got holes in our business, and you know, sometimes we just don't know where they're at, and we need an outside source, somebody that's very skilled and adept at, you know, finding those holes in our business, so we can be profitable, healthy, and we can continue to do what we're good at, which is, you know, either, you know, chasing that next deal, pursuing other ventures, and not getting caught in the muck and mire of, I mean, in my world anyway, that's like the least favorite thing I ever want to do. But I mean, that's honestly probably the most important
Well,
thing.
it's everybody's least favorite thing, right?
Yeah.
It is doing the
Everybody I
books.
know.
You know, even for all the companies I run, I hate doing the books, but it's something that I really discipline myself on doing, just because to your point, there may be holes there that you're not seeing if you're just running the day-to-day operations and moving through with it. And I think that's where, you know, we can come in, both on the tax side and on the bookkeeping side to let guys like you go do your thing. You know, go find your next deal, go flip your next house, and keep you moving in that direction. And we can take care of the books for you.
Investors are, myself included, and I'm probably the biggest culprit, but a lot of times we'll confuse activity for progress. And so we're a flurry of activity, but we're not, you know, we're missing the holes in our business, and we think the activity means progress, when quite honestly, you know, we need a good assessment of our, you know, a current state of affairs in our business.
Yeah.
Yeah, let me know how that launches, because I honestly, I know you're kind of in the infancy and what that's going to look like, but I think could be a real key and asset to investors.
And I think if you bring up another really good point there too, with maybe not even knowing it, but there's a lot of, it's not just that activity, you know, seems like success, but there's a lot of times that growth seems like success too, right? Where we're just trying to get bigger and bigger and bigger, and that may not be the most profitable way to go about things. And I think it all comes back to really knowing what your financial situation looks like, and keeping your books in line, and knowing that, you know, maybe adding these 3 more investments doesn't really provide me with any additional profit, and you may be profitable by not having those investments.
Yeah, very cool. So I'm going to lean on you just a little bit. I'd love to hear in complete confidentiality or whatever, but you know, I know you work with a lot of investors. You know, this is a real estate show. You know, I'd love to hear, you know, again, without disclosing any confidentiality or anything, but I mean, what are some of the common, I don't know, say complaints, or some of the, you know, maybe the common things that investors are coming to you with, or what are investors doing wrong that they need to be doing differently, perhaps, and maybe something other than what we've already covered, perhaps.
Yeah, I don't know that there's a whole lot of what investors do wrong. I think a lot of what I see is bad information that investors get.
Okay.
You know, there's a lot of folks out there that push different strategies or different schemes, and you know, I'm sure you're familiar with most of these things.
So, for instance, when I was told cost segregation is a waste of time, and you know, it's not necessary.
Yeah,
it was terrible advice I got for 2 years.
Yeah,
and I kept asking over and over and over again, and it's like, oh, it's a waste of time. I don't want to do it. At the end of the day, he just didn't want to do it.
Yeah. I mean, so I think there's two places where bad advice like that comes from, right? There's old school advisors out there that is not familiar with current technology and current techniques and things like that make things that, yeah, honestly, 20 years ago you would have never done, but you can do today. You know, like we were talking about earlier before we started recording, how it used to be being a remote landlord was a lot harder than it is today. You couldn't own properties in other towns and stuff, but today that's incredibly easy.
About it now,
it's like being in your own backyard still. And so things like cost segregation and those different strategies are easier today than they were years ago, and they're much more profitable for investors than they were years ago. You know, they've gone from costing thousands of dollars to costing hundreds of dollars. You know, and there's options out there that you can do them for real cheap, which, you know, I'll be honest with you, I don't recommend, because it's much like a lot of things in investing. You kind of get what you pay for, right? There's a difference between the $1 a square foot work and the $3 a square foot work, right?
100%, yeah.
Yeah, and I think you see a lot of other bad advice that comes from folks that are pushing advice to sell in some of the podcast formats you get around real estate and books and stuff like that, you know, where there's a lot of misinformation out there that, oh, hey, go start your LLC and you don't have to pay any tax, you know, and that's just not accurate. No. And so you see a lot of new investors. I was going to say young, but not all new investors are young, right? That kind of fall into those traps. And I get so many of those questions every week, and from new investors, old investors, whatever. I can usually tell what's popular in in the YouTube podcast segment based on the questions I've got that week. I know I'm like, without even listening to anything,
100%.
I can be, okay, this is what everybody's talking about this week.
100%. Yeah. And okay, thanks. So, yeah, 100%. What's the saying? Like, free advice isn't worth what you pay for it, or something like that. Everybody's, the opinions that some have, and this happened today. I saw this on Facebook today. Somebody gave some advice to a young investor, and I was just shaking my head. I'm like, that is the stupidest thing, but you can't sit here and dispel all their myths or whatever.
Right. Yeah.
So I'm guessing, much like when I came to you, I encourage anybody as you talk to an advisor, an accountant, a consultant, or anything, come ready and loaded with questions, because when you're tapping into an expert that's in their field, you really, 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 really need to be prepared. And I assume you're not offended. I mean, I don't think you were offended when we sat down. I mean, I had a lot of questions. I appreciate the
wanted
to dig in, and every investor needs to know that, like, it's your business. You need to be very vested in it, and you need to know that who you're working with is going to be working on your behalf, and you're not just going to get a yes man, or just some regurgitated advice that really is no help to your business. And so it should go without saying, but I'll say it again, when you're talking with professionals and advisors, advocate for yourself, ask questions. That being said, Kyle, what are some of the, maybe you said dispel some myths? I mean, bad advice. What's some of the burners you've heard maybe lately or in the past years, of like your head scratching moment of like, I can't believe that. That's ridiculous.
The big one out there has always been this, form all these LLCs, and you got to have hundreds of LLCs, and each property in a different LLC and stuff like that. And I'm not sure where that advice comes from. Somebody selling LLCs, apparently.
Apparently, yeah, the CPA, the attorney.
And I always tell everybody, hey, I'm happy if you want to put 100 properties in 100 different partnerships, because that's 100 tax returns I get to do for you. So I'm more than willing to do that. But there's really no reason to. There's some potential liability reasons that you want to break them up into different LLCs at times.
Right.
But I would stack, 10, 15, 20, 25 properties into an LLC before I worried about doing that. Otherwise, you're just increasing your compliance costs and headaches.
For the record, I've got 2, and I'm happy with that, and I probably won't.
Yeah.
Shift.
I think that's totally appropriate.
One question just came to mind, and I don't know, you can dodge it if you want to, or not answer it. What can investors know about trusts? Are you familiar with like living trusts and
Yeah, trusts are a good estate planning vehicle. They are. You see a lot of, again, trusts are sold to a lot of people even when they don't need them. I think they're great. I'd recommend them to clients from an estate planning perspective. But there's other things that you can do as well on the estate planning side. And really, estate planning is only going to be needed once you get to a fairly large estate as well. That's kind of the secret in the estate industry that a lot of people don't want to put out there. Again,
Really?
Nothing wrong with doing them. I have plenty of clients that do them. And I'll recommend doing them for sure.
Mm-hmm.
Doesn't change your tax returns or anything short term.
Mm-hmm.
It's they essentially don't exist until you pass away, and then they spring to life and that sort of thing.
I know at times some investors that maybe want to bury the ownership of a property, they'll bury it in a trust.
Yeah, you can do that with certain types of trusts as well, and in certain locations. A lot of that depends on where the trust is and how you use it and things like that.
I know a gentleman that does quite a few subject to investing, and so I've used that strategy a time or two, and he suggests putting them into trusts. And I don't know if you're familiar with that, but it's essentially you're taking over existing mortgage, and you're placing them in trusts and custodians of the trust, and there's 7 degrees of separation on everything.
Right. Yeah. When you're looking at doing things like that too, there's a few states out there that don't disclose owners of LLCs and stuff like that. Right. So you can park them in those types of LLCs. I think maybe Nebraska is one of those, or Wyoming or something like that. One of those.
Ever heard the one like all your LLCs need to be in Nevada or Wyoming or
Yeah. Yeah.
what's our
Yeah.
Delaware? What's the
Yeah.
they just have more favorable.
A lot of it goes back to Delaware because corporate law and LLC law sort of started in Delaware, so they've got the
Okay.
longest history and the most precedents and things like that.
Okay.
Which is interesting in that if you look at some of the real legal concepts around it, where you would be sued in cases and stuff like that take place is probably going to be where that activity takes place. So even if you got a Delaware LLC or a Nevada LLC, you're still going to be subject to Kansas law if you wrong somebody in Kansas.
So yeah, there's another.
Yeah,
Compelling myth.
you see a lot of those type of things out there.
Awesome. Well, we're as we turn the corner, I've got a couple more questions, and I'd love to. 243. This is where he'll edit out.
If you want to keep going, I can come back at another day and we can add
Honestly,
to it.
I told Caleb, I said, if I need anybody, I'm going to do a two-parter, it would be with you. Because honestly, I'd love to dive in extensively to, yeah.
Yeah.
Dude, you can come in every month.
Happy to
a
do that.
Monthly Kyle Turner update or something. Because seriously, like, Kyle Corner, there we go. You need to be on this seat over here. Yeah, quite honestly, I've heard it put best this way that the IRS incentivizes citizens, investors in a certain direction. And I always looked at the IRS adversarially, like they're the big bad guy. But realistically, the tax code incentivizes investors to go a certain direction, and the savvy investor will go in that direction.
Oh, absolutely. When you look at cost segregation and the bonus depreciation, that's really for 22, 21, 23, the bonus depreciation that you get out of cost segregation is a huge benefit to it. It takes cost segregation and moves it from a major benefit to just a monumental benefit,
Mm-hmm.
right? And all of that is the IRS code, the Internal Revenue Code, trying to force behavior. And so they give you that bonus depreciation to incentivize you to go out and spend money on capital assets.
Mm-hmm.
And so that's exactly the behavior it's driving, right?
Mm-hmm.
And to your point, understanding the behavior that the code is trying to generate can help you as an investor and a taxpayer in general to end up in a favorable tax position.
I mean, and this is where the moniker, the rich get richer. I mean, this is, you follow the incentives that the tax code allows, and you'll be rewarded. If you fight against the incentives, and then you're going to be paying more taxes. And that's been my
absolutely
minuscule understanding as I've talked to guys like you. Like, okay, I'm not the sharpest tool in the shed, but if you tell me to go here and things will go easier, if I go this way, they're going to be an uphill battle. I'm going to go this way, and that's essentially what the tax code is.
Yeah, no, I agree with that.
That's the most fundamental, rudimentary explanation. So, well, Kyle, our time's come to an end. Apparently, we have just adopted you for a recurring guest, so I really appreciate that.
That's great. Yeah, I love it.
I'll have some swag next time. And as we close out this podcast, Real Estate Investing for Real, again, our purpose and goal is to, honestly, bring content, bring value to investors of all stripes and all persuasions, no matter what your investing strategy is. And quite honestly, we can help inspire one another and, raise the bar in investing, and have a little fun doing it. So I think we've accomplished that today. Kyle, again, thanks for being with us. I really appreciate it. And until next time.